Salesforce stock fell 45%. Its AI grew 200%. Agentforce barely existed 2 years ago. Last October, it crossed $500 million of recurring revenue. By February, $800 million. By May, past $1 billion. Over the same stretch, the share price went from about $275 to nearly half that. The product is working. That is what frightens people. Read the latter honestly, though. 330% growth, then 169, then about 200. The dollars climb, the rate does not. Salesforce charges per person. Agentforce does the work those people were hired for. If the agent closes the ticket, nobody needs the license for the human who used to. The better the software works, the shorter the invoice gets. That is the whole argument, and it fits on one line. 5 published methods score this tonight. Greenblatt, Buffett, Druckenmiller, Ackman, Graham. Every score stays sealed until its chair votes. Nobody invented this fear online. Salesforce cut 4,000 support roles, and Marc Benioff said AI was doing up to half that work. He ran it on his own staff first, then he sold it to everyone else. 1 ticket, 2 in the morning. The agent reads the account, issues the refund, closes the case. No queue, no shift, no license. 61 stories on Mission Street, the tallest thing in San Francisco, paid for by logins. A sales rep opens a laptop at 7 in the morning and types a password. Salesforce is paid for the password, not for the work behind it. About 1 trillion API calls crossed the platform in 1 quarter. 28.6 trillion tokens, up 152%. This is welded into how those companies operate. Pulling Salesforce out of a large company is not a software decision. It is a 2-year project with a budget and somebody's career attached. Then Salesforce shipped something that does the job instead of the person and put a separate price on it. People making the case against are paid to be right, and they have 4 things: a downgrade, an analyst who said the quiet part, a license redesign, and a missing line. Morgan Stanley cut its price target from $287 to $185, not on a bad quarter, on this. A Bank of America analyst wrote it down plainly. As Agentforce automates case resolution, it reduces the number of humans who need a subscription. That is not a risk factor. That is the product working. Salesforce showed what that looks like from the inside. 4,000 support roles gone, AI named as the reason. The first customer to shrink was itself. Now Salesforce is proposing a separate license for the agents. Read that as an admission. If charging per human still worked, nobody would redesign it. 3 pricing models run at once: $2 a conversation, flex credits, per seat add-ons. Ask what a customer pays next year and there is no single answer. The sharpest fact in this file is a line that is not in it. Salesforce discloses no net revenue retention. It reports no seat count at all. So when somebody says there is no evidence of seats being destroyed, they mean no disclosed evidence from the party that decides what gets disclosed. And Salesforce is buying Fin from Intercom for about $3.6 billion in cash and stock. The split has never been disclosed. It is paying billions for software that answers a ticket without a person. That case is coherent, it is documented, and it is argued by serious people. And yet, 4 things have to survive a 5th. None of these are forecasts, all of them are already filed. Full-year revenue, $41.5 billion, up 10%. The first quarter after it, $11.13 billion, up 13%. And Robin Washington, who signs those numbers, raised the guide instead of cutting it. 7 of the 10 largest deals last quarter added net new seats, not renewals, new names on the license. Top 10 deal value rose 2.5 times to $800 million. Headcount rose 9% to 83,334. Support shrank, sales grew. A company being eaten by its own automation does not hire 9% more people. More than $1 billion of recurring revenue is Salesforce's own phrase for Agentforce. Benioff will not give a tighter number, so neither will we. The panic is loud, the filed numbers are stubborn, and the most interesting objection tonight is sitting on a page nobody is reading. 5 chairs, 5 published methods run as models, never the men, Greenblatt ranks, Buffett tests the business, Druckenmiller trades the turn, Ackman underwrites, Graham counts what is owed. The Joel Greenblatt model, 2 numbers ranked across the whole market, how cheap the earnings, how high the return on capital. The AI argument is not an input because it is not a number.
Input 1. The fall pushed the forward earnings yield to between 7.5% and 8.5%. The formula does not thank the panic, it ranks it. Input 2. An operating margin close to 35% on a business that needs almost no hard capital. Cheap and high return clears the screen. Greenblatt wrote the limit down himself. The formula buys average businesses at wonderful prices, and it cannot smell decay. It would have bought this the morning of the downgrade without reading it.
The Greenblatt score, an 8. The coldest chair opens with the strongest buy. The next method has spent 60 years asking something else. The Warren Buffett model, a wonderful business at a fair price held for decades, switching costs, return on capital, and what management does with the money.
The business passes the first test easily. A free cash flow margin near 35%, and a product companies do not rip out, because ripping it out costs more than keeping it. The unease is not the product. $25 billion of buybacks funded with debt is exactly the capital allocation this method distrusts. The moat is real. The financing was a choice.
The Buffett score, a 6, favorable on the business, uneasy on the financing, now the fastest chair in the room. The Stanley Druckenmiller model, find the inflection, size it hard, be willing to be wrong quickly. It does not need to know how the story ends, only which way the curve is bending.
3 prints, 500 million, 800 million, past $1 billion. An inflection with 2 confirmations, and the third one due inside a quarter. So it buys small and writes the exit before the entry. 1 more quarter on that ladder and it sizes up. 1 flat print and it is gone.
The Druckenmiller score, a 7 conditional, 8, 6, 7, 3 flavors of yes, then the room turns. The Bill Ackman model, a handful of simple, predictable businesses understood completely. If it cannot be underwritten in one sitting, it is not owned.
Agentforce runs 3 pricing models at once. $2 a conversation, flex credits, per seat add-ons. Ask what a customer pays in 2 years, and the model cannot answer. And the documented worry in this method is premium software priced above what a rival can now replicate. Complexity it cannot underwrite is complexity it walks away from.
The Ackman score, a 3, a pass, and the last chair is not going to argue about AI at all. The Benjamin Graham model, earnings power, the balance sheet, and a price low enough that being wrong is survivable. It does not forecast, it counts what is owed.
So it counts $25 billion of buybacks funded with debt, notes up to $31.4 billion, $11.8 billion of liquid assets on the other side. And to carry it, Salesforce cut its own free cash flow growth guidance from 9 or 10% down to 4 or 5. It priced the buyback for you in its own numbers. 20 times trailing earnings with a balance sheet moving the wrong way is not a margin of safety. This is the only objection in the room with nothing to do with robots. He passes on the leverage, not the story.
The Graham score, a 2, the lowest on the board and the only chair tonight that never mentioned AI. The composite, 5.2 out of 10. Greenblatt 8, Buffett 6, Druckenmiller 7, Ackman 3, Graham 2, read the spread because the split is the verdict. 6 points between the formulas 8 and Graham's 2. 3 chairs said yes for 3 unrelated reasons. The 2 that said no do not agree either. 3 lenses, method 5.2, split wide open. Money, not one of these methods is backed by a real position here. Crowd, still arguing over a seat count nobody has published. The stock did not fall because the AI is failing. It fell because nobody outside that building can prove it is working, and the one party who could prove it has chosen not to.
The board's verdict, in the board's language, hold. Cheaper than the store it was priced on, not cheap against the balance sheet it now carries. The chair that stayed with me is Graham. Everyone in this argument is watching the robot. He was reading the notes payable, 25 billion of buybacks on borrowed money, and a cash flow guide cut to 4 or 5% to carry it. And on the question everyone is actually asking, are the seats dying? We are not allowed to know. No retention number, no seat count. Salesforce chose that before anybody asked. One thing before you vote, everything you just heard came from AI models of these investors' published methods. Not the investors, not their firms, and not investment advice. The numbers were July 2026.
3 things would move every score here. Does Agentforce print a 4th number above that ladder? Does Salesforce ever publish a seat count? Does the cash flow guide hold at 4 to 5% or slip again? Flip those and a 5-2 board becomes a 7 or a 3.
That is the board on Salesforce. The rule of this table never changes. The methods vote, the men do not. So which chair got it wrong tonight? Mine was Ekman, and I will defend that in the comments. Take your seat at the table.
Case filed, the stamp is already inked for the next name.